Hello, William Smith here with the Carmel Luxury Group at Coldwell Banker Realty in Carmel by the Sea. I have the pleasure of having Chad Hawker from Signature One Lending with us on our vlog. And Chad, thank you for being here.
My pleasure, William. Always.
Well, I've got some interesting information that I'd like to get from you. We've had some previews of what we're going to talk about, but the first thing I wanted to say is congratulations on number one status in the country for Synergy One lending. Again, you've done it repeatedly, but it doesn't surprise me, but it is an honor to be able to be one of your clients, and all of my real estate clients have benefited from it. So congratulations.
Thank you. And I just want to, with the congrats, I'm humbled by it, but it doesn't happen without an amazing company and an amazing team that work behind the scenes to make me look good. And it doesn't happen without amazing agents like you and clients that I get to work with and I get to help. It's a beautiful win-win situation for all, and I'm extremely grateful for so thank you for that.
Good. Well, I have to tell you, speaking of my clients, I was asked by some clients of mine, where can we get a good refi? And they had been talking to some people, but weren't satisfied with anybody. And I said, there's only one choice. It's my second choice too, and my third choice, Chad Hawker, Synergy One Lending. Their comments to me were so glowing. They said, William, thank you for recommending Chad Hawker and his team. They're so professional. And he's an architect, she's an artist, but she had been in marketing. They come from an urban environments. They're used to really fast-paced big companies. They said that the personal service that you and your team gave them, every one of your team members was included in that compliment. I said, boy, that's great news because obviously when a real estate broker refers their clients to a lender, we need to make sure that they're well taken care of. You took great care of them. Thank you very much.
Thank you. And you're right. I take that very seriously. And I not only want to give the clients that wow effect, but I want the agents to be validated
Uh,
for the fact that they're trusting me to take care of their people and they become our people to take care of. And thank you for that.
all right. Well, your whole team, every we could just go right down each name. Every one of them really does their part of the transaction so well. I can see why it makes your job just so smooth. So that's good.
Thank you. Thank
Good.
you.
Well, I've got three areas I'd like to cover. I'm going to start with this has been a wild real estate market in 2024. Here we are in mid-August. I wanted to get you to just give us a recap of what happened, where it went, what was the prediction, what actually happened, how you maneuvered your team through all of this for your clients.
Well, absolutely. And I would be happy to. Really, there's two angles, there's the real estate side and then there's the lending rate side. And they obviously come together because that's what people look at when they're looking at purchasing a property or refinancing a property. On the real estate side, as you know better than I, it's this balance of inventory. For the most part, we've had very little inventory to work with this year, and that creates a surplus of demand that creates really a seller's market and makes it more challenging for buyers because we see with a demand that exceeds that of supply, values continuing to rise. And we are on track to match that of expectations of about a 5% increase in
Uh-huh.
home values this year, maybe even a little more. Of course, there are parts of the country that haven't seen that, but for the most part across the country, it's going to end up about a 5% appreciation. So you have that on the real estate side, demand exceeding that of supply, and it's important for buyers that want to get into this market to understand that this idea that we hear often in the news, in the media, that values are going to decline, that there's potentially I don't hear of it much anymore, but there's somehow going to be a crash. there's no data that supports that currently. And
Uh-huh.
so some clients eventually get to that understanding and realize that waiting is not the answer. Being proactive is the answer, getting out there, because on the other side now are interest rates. Interest rates continue to be an interesting dynamic because of primarily the Fed
Uh-huh.
and their understanding of the data. And they're walking a tightrope as they've increased the Fed funds rate and did so faster than they'd ever have in history following the pandemic. And as they've kept that Fed funds rate higher than originally anticipated, it is clearly putting a strain on the economy. And they haven't cut their Fed funds rate yet. Many don't agree with this
Uh-huh.
because they feel like inflation is still a concern. When you dive into the aspect of inflation, you do realize that inflation has come down quite dramatically. It
Mhm.
was, depending on what measure of inflation you're looking at, there's PPI, there's CPI, there's PCE. Fed focused primarily on PCE, but the long story short, all of these inflationary numbers have come down. We're at technically about a 2.5%. They want us at 2%.
Mhm.
And we are very close to getting there. But because they put so much focus on that and less focus on, say, the job market, it's starting to push so much strain on the job market because they're waiting on inflation to come down. So when you dive into the inflationary numbers, you have to analyze what is causing or delaying the inflationary numbers. It's, again, not to get too much in the minutia of it, but most of the inflation has been driven by what is called shelter costs, which is a slow moving number based on rent and so
Uh-huh.
forth. And believe it or not, auto insurance. When you strip those two things away, inflation has been somewhat flat over the last 6 months. And so it's important for them to acknowledge this because inflation really is very close and going to hit their target. And that should give them the confidence for rates to move down. But then you have a job market that is really showing signs of weakness. But a lot of the year, we have not been getting accurate information on the job markets from sources such as the BLS, which is the Bureau of Labor Statistics.
Uh-huh.
Their methodology for analyzing is highly in question because a lot of it is outdated and is not painting an accurate picture. And just for instance, last year alone, they had to make major revisions to their employment numbers to where they overstated job growth by almost 750,000. But unfortunately, the market already moved on the false data of that job market. So I share all of that because many had thought rates would have moved down further by now.
Uh-huh.
But because of the data not being accurate, because of inflation being the way it is and how it's measured, we haven't really seen them be proactive to cut the Fed funds rate and see rates move. So where does this put us? We've seen rates higher than we anticipated. They're still now at about the mid sixes. We saw them go up to 8% for a period of time.
Uh-huh.
Um, and now that we just a few weeks ago saw the unemployment rate jump from 4.1 to 4.3, the Fed did not believe the unemployment rate would jump above 4.1. So this has been a shock to them. And this is why rates took a pretty big jump a few weeks ago. And now we're seeing them back into the sixes. And they are acknowledging that most likely they will be making their first cut to the Fed funds rate next month of September.
All right, so let me stop you there because my next question is, we've got 5 months left in this year. What do you see going forward from August through December 31st and then on into the first quarter of next year? What are your experts telling you?
The experts are telling me we've got a couple of dynamics happening. We're going to get clearer and clearer signs of a weakening job market, which oddly enough is good for interest rates. That is going to force the Fed to start cutting more aggressively. That will in turn move interest rates down. And although I do think that the election will also play an important part, we may not see rates really move significantly until after the election for various reasons. But I do believe that we will see at least two cuts this year from the Fed, 50 basis points. Now, it's important. I've already been on the call twice this morning, and it's only 10:15,
Uh-huh.
of people not understanding the Fed funds rate.
Uh-huh.
Mortgage rates don't move when the Fed cuts. Mortgage rates move based on the expectation of what the Fed will do. So a few weeks ago, mortgage rates moved down because the data reflected they will probably end up cutting 50 basis points. So we've already moved based off the assumption of a cut. So based on as we move forward, if we get more data confirming a weakening job market, confirming a weakening economy, which then will force the Fed to cut more aggressively, we will see interest rates move down further and further. And then a couple of things will happen. Margins will decrease, and rates, I believe, might hit low sixes for a 30-year fixed, and then early next year move into the fives.
All
It is
right.
my prediction.
All right. So with that information, somebody comes to the Carmel Luxury Group. They ask us to find them the perfect home. We find them the perfect home, and we have already had them come and be pre-approved with you. I'd like you to touch on that just briefly, the difference between pre-qualified and pre-approved in a few sentences. But we get them pre-approved with you, and now we're ready to make that offer. What are some of the things that you're explaining to them on how to strategize getting this property purchased and make them attracted to the seller for being the right choice if there's a competitive offer, and what is the best way for them to strategize for how in the future lower interest rates might then play into what they've done today?
Great questions. So first and foremost, I stress the importance that now is the time to be proactive. We know interest rates are falling, but the biggest mistake you can make is waiting until rates fall. For every 1% drop in rates, 5 million more buyers into the market. So we have low supply for the most part, already demand that exceeds that. Rates fall, demand skyrockets. It makes it harder for buyers to proceed in that market. So being proactive now and getting out there, getting into contract now will allow you to negotiate more, get the price for lower, and then we can refinance later. So that's step number one. Step number two is getting pre-approved. So the mistake that a lot of people make is, I'll be really frank, there's a lot of, I'm hesitant to say this because I'm not attacking one particular person, but there's a lot of lazy loan officers out there. What I mean by that is they start issuing pre-qual letters based off of a conversation with a client. That does not give assurance as to a client's ability to qualify. It doesn't give a client the ability to understand all the reliable, clear information about what that financing is going to look like based on looking at the client's data, having them go through an application, provide the documentation that I need. When I have that, not only can I issue what is called a pre-approval because I've analyzed every important detail tied to their ability to get a loan, but I've also with that been able to give them very clear information about what their payment's going to look like, what rates are going to look like, what their costs are going to look like, what their down payment's going to look like. They can go out there and look for properties and know exactly what their financing is going to look like. And that changes the dynamic of everything compared to, oh, this is maybe what it's going to look like, or you should be able to qualify. This is the largest investment that people will ever make. And they need to have all this information to be able to go out there. On the next level beyond that, in a competitive market, we can take a pre-approval and we can take it a next step further to have it actually underwritten by an underwriter. So when you go to write an offer, now we are completely ready to go. It's already approved. You can write an offer with a 15-day close. Sometimes because we're already approved, based on the appraisal, we can go no loan contingency, no appraisal contingency, even though we'll be doing an appraisal, close in 15 days. That is going to allow the client to be as competitive as possible in the market. But it all requires that I get a chance to work with that client to create this kind of foundation prior to them looking for properties. Next step after that is part of what I do through this conversation is create not a plan for purchasing, but what comes after that. Because
Uh-huh.
as we've discussed, rates are going to fall. So we need to analyze what pricing are we going to do now, knowing that this loan probably will only be a short-term 6 to 12 month loan, because then we're going to be able to refinance that mortgage, get a much lower interest rate, save money. So we don't want to spend unnecessary cost now, knowing that we will be able to refinance and get out of this mortgage later. So it really is a strategy to be proactive now, create this foundation prior to looking for properties, be clear on what those expectations are. Then they can understand when they're going out with you what that looks like and be confident about the strategy.
Uh-huh. Well, let's throw out a couple of words that I'm sure when realtors say, okay, we can do a 2-1 buy down. This will be great. Let's go ahead and put that in our offer. And the buyer's saying, okay, I've heard of that, but I really don't know what it is. So that's one option. Or maybe I can get an interest rate where I don't have any upfront costs because I know that I can lower my payment when I refinance in 6 months. So that would be a no of a low fee loan. What does that look like? What are some of the weapons in your arsenal that you can use to be able to get your client into that house today and in anticipation of maybe 6 months from now refinancing when interest rates come down, maybe even into the fives?
Well, you touched on really some of the major ones. So there is a product called a 2-1 buy down. Basically, it's a temporary 2-1 buy down. So as we said, now is the time to still be able to negotiate with sellers because the demand, although it is pretty high, we're still able to negotiate because it's not out of control demand, right? Once it gets out of control and you've got 10 offers on a property, sellers are going to be less likely to give to a buyer, right? But the 2-1 buy down is a way to negotiate with the seller. Say the property is listed at 1 million, and obviously the buyer wants to reduce their payment. We know interest rates are falling. So instead of going in at say 950, right, which is a 50,000 less to the client, you can request what's called a 2-1 buy down. So for instance, on a $1 million purchase, $800,000 loan, if you get an $18,000 credit, what that is doing is it's subsidizing the buyer's payment. So instead of saying have a 7% interest rate, for year one, it gives them a 5% interest rate. That
Wow.
saves about $1,000 a month on their payment, which is technically paid for by that subsidy from the seller. Remember, it was 18,000.
Uh-huh.
So 1,000 is used every month, right? Which is subsidizing that 1,000 drop to the buyer. So it's used incrementally, 1,000 every month, year one, because it's going from 7 to 5 on an
Uh-huh.
$800,000 purchase. Year two, it goes to 6%. So instead of 1,000, that's now about $500 savings a month. Year three, it just stays at the 30-year fixed rate of 7%. But take a step back further and realize what's going to happen. So we have rates falling, let's say 8 months
Uh-huh.
goes by, right? Instead of using 18,000 all at once to drop down the rate permanently, you're just getting $1,000 monthly. So in 8 months, you have used $8,000 because it's $1,000 every month, right? You've only used $8,000 of the $18,000 that the seller gave you. Now it's time to refi. Rates have dropped. You can take that $10,000 remaining. Remember, there was 18, you've used 8. Now you have 10,000, you can apply that towards both a refinance, getting the rate down further, because now this is going to be a permanent refi that you're going to take advantage, or you can take that 10,000, apply it to the principal. It's money that you can use in the future to apply. So it's allowing you to bridge the gap with the seller's negotiation to give you a much lower payment, money left over to then refinance when rates fall. And so a seller is going to be much more inclined to do that than a big price reduction of 50,000. So that's one strategy. And then just looking at the specifics of each individual borrower and looking at strategies such as a 2-1 buy down, or like you said, paying less costs but accepting a higher interest rate now because that'll save you money, which you would waste unnecessarily anyway, to then refinance in 6 to 8 months when the time comes. But there's so many scenarios. We have really every product that is out there, we have it. And it just takes a case by case understanding of the goals and the needs of a client. And that's our job, is to help clients navigate through that and understand the options and understand why the option we're choosing is the best one for them.
Right. Well, that's exactly why when people say, okay, well, what do we do about financing? We say, go to see Chad at Synergy One Lenders, and then go ahead and get all the opportunities that he has available for you. Once he tells you what your qualification is for the loan, you tell him how much you want to put down payment. We have a budget and we'll find the right house. But those explanations are so helpful. Thank you very much.
Thank
And
you, William.
so when somebody says, I just want to ask some questions of Chad because I'm thinking about buying, but I'm not ready really to engage with a realtor yet. How is it that they can get hold of you, and what are the steps you would recommend they take?
Yeah, well, how they get a hold of me, if you could put my information up on the screen, that would be helpful. Just shoot me a text or shoot me an email. Well, I always like to have just at least an initial conversation to have a basic understanding of where our clients are
Uh-huh.
and to determine the next best steps. Is it premature to do a pre-approval, or is it the right time? My feeling is it's almost never premature to do a pre-approval, because think about a pre-approval as just a financial plan. It doesn't necessarily mean you're ready right now.
Uh-huh.
It means that you want to understand the moving parts that goes into it. So if we can plan ahead and you intend to buy in a year from now, we can make sure you're doing the things necessary to move you into that position. You don't want to, with not an understanding of the loan process, you don't want to make assumptions. We know what happens when we assume, right? So let's go through this process. I don't charge anything for it. We can give you clarity on what you need to do, and whether it's now or in a year or 2 years from now, we at least know we're moving in the right direction. So I'd be happy to have that initial conversation with clients.
Good. Well, I know that for a refinance, uh, we sought your advice. You gave us advice on what to do. We watched the market and we waited about 3 months, and then you said, now. And it was brilliant. And I've lived, and you did the same thing when it was time for us to purchase the house. So my wife and I really enjoyed that.
Thank you,
Well,
William. And to that point, actually, I think this is an important point.
uh-huh.
As rates fall, people are going to be attacked by lenders from all angles, mail, phone,
Yeah.
texting, right? Let's be real, most of them really just want to get a deal done, right? They're
Uh-huh.
not looking at the overall picture of where they are, what are the costs, what are the savings, what are we looking at for the future? Is now a good time? Or if we know that interest rates are falling, to such and such, for the most part, we don't know, but if there's a strong indication that they are, let's create a plan, allow me to be tracking that, and then we will jump on a refi when that opportunity happens, just as you're saying. Try not to get sucked into these, unfortunately, these lenders that are just trying to get a deal done. They just want to get it done. It's not really the best time to do it, but they're going to convince you that it is. So I'm very passionate about the timing of a refi and making sure it's fitting with the overall picture of the client.
Good. Well, Chad Hawker, Synergy One Lending, lender for life. And I am a proud client, and I am very happy to be able to refer my clients to Chad. So, Chad, thank you very much for spending some time with us. we're going to get this information out to the public so that they can get hold of you. And I'm sure by the time that this year ends, there'll be a whole bunch more for us to talk about.
Absolutely. Thank you, William.
Talk to you later.